It's time for us to spend a little time talking about what title insurance does. As we mentioned in the previous section, title insurance is a contract of indemnity against loss due to defects in, liens against, or encumbrances upon a title. At this point, you are probably saying, yes, but what does that actually mean? Don't worry, we're going to spend some time speaking in English now. First of all, a title policy is a contract of indemnity. That means that the company will hold harmless or make whole the holder of the policy. This does not necessarily mean that the insurance company has to pay out money to the policy holder, but rather that they must restore the value of that which was lost. If, for instance, an unknown heir from the back chain of an insured title appears and claims ownership of half of the property, this case would be filed as a claim with the insurance company. The insurance company must then decide how they would like to handle the situation. If they believe that the heir's claim is weak or illegitimate, they might choose to argue the policyholder's case in court. If the claim is strong, or court costs potentially higher, the insurance company might choose to pay the heir for his share of the property, or they might simply pay the policyholder directly for the value of what they have lost. Title insurance is an improvement upon other forms of title assurance in that it protects the policyholder against more than just those interests, liens, or encumbrances that are a matter of public record. As we have already discussed, earlier forms of title assurance were limited to what could be discovered in the public record, and provided no assurance or protection for any interests outside of the scope of that examination. While title insurance reports and policies are still based primarily on public record, they now protect the owner from all liens or interests, including interests created by completely unknown title defects such as fraud or unknown heirs. Another important point to mention is that the defect, lien, or encumbrance must result in an actual loss in order for a claim to be legitimate. Assume, for instance, that the front of a house encroaches up to 2 feet onto the bed of a proposed street widening. However, due to an error on the part of the examiner, the street widening was never discovered and made a part of the title report. The fact that the owner later discovers the street widening and the resulting encroachment does not entitle him to compensation under the terms of the policy. The owner has not lost any money as a result of the discovery. However, if the town or city decides to enact the proposed street widening, it would have the right to force the homeowner to remove the house from the bed of the street. The cost, or actual loss, associated with such an endeavor would be astronomical, as it would most likely involve tearing down the entire house. Such a loss would be a legitimate claim under a title insurance policy. Finally, a policyholder cannot file a successful claim based on liens, encumbrances, or interests that are created after the date of the policy or are created by an act of the insured. Now, this may seem like common sense, but it is important to recognize exactly where and how title insurance policies get cut off. Let's start with a basic example of an individual purchasing a house. If that person makes a mortgage in order to buy the house, that mortgage is a lien against the property and would normally be included as an exception in the policy's Schedule B. However, even if the company left the mortgage out of the policy, the fact that it was the insured who created the lien by making the mortgage would disqualify them from claiming any title loss based on that mortgage. For instance, if it is foreclosed and the owner loses the house. Similarly, judgments and liens against a purchaser, even if they are entered years before the purchase takes place, will automatically attach to the real estate as soon as it is transferred to the individual. These liens against the property, even though they are the result of something that happened before the policy date, were also the result of an act of the insured and are therefore not subject to claims. Finally, even if an encumbrance, lien, or interest is not the result of an act of the insured, if it occurs after the policy is issued, it will not be a legitimate claim. For instance, if the municipality decides to widen a street, it can take a strip of land for the widening from the property lining the street. This taking will probably result in a financial loss for the homeowner when he sells the property, and it is not a result of an act of the insured, but because it occurs after the policy has already been issued, it is not a potential claim. Title insurance policies are the final product of our office. They are the actual contracts that provide coverage to our clients. There are 3 general types of title insurance policies that we will issue based on 3 classifications of interests: owner's policies, sometimes called fee policies; mortgage policies, sometimes called loan policies; and leasehold policies. However, leasehold policies are relatively rare. The vast majority of the policies issued by our office are either owner's policies or mortgage policies, and those are the ones we will be focusing on for the sake of your training. These policies, while similar, do have some fundamental differences. The owner's policy. This type of policy ensures an ownership interest in a piece of property, often referred to as fee interest or fee simple interest. It ensures owners, who are usually but not necessarily new purchasers, that 1. They own the property. 2. No one else has any legal claim or interest in the property except for those exceptions to title listed in the policy's Schedule B. 3. There are no liens on the property except those listed in the title report. 4. They have access to and from a legal street. 5. The property described in the policy, the Schedule A, is properly described and that the description is complete. Fee or owner's policies require a one-time premium payment and do not expire or depreciate over time. The policyholder has the right to make a claim for amounts up to the face value of the policy as long as they or their heirs remain in title. Therefore, if a couple bought a home in 1963 for $20,000, purchased title insurance, and then later died and left the house to their children, those children could file a claim based on their parents' policy. However, in the case of a total title loss, the children would find themselves in a bad position, since they would only be able to collect up to the face value of the policy, $20,000. which would fall far short of the current fair market value of the home. Mortgage policy. This policy is used to ensure the interest held by lenders as a pledge or security for the payment of a debt. In English, this policy is issued to a bank or lending company when they lend to a homeowner. The policy ensures that 1. The borrowers have legal title to the property. 2. No one else has any interest in the premises except for those exceptions listed on the policy's Schedule B. 3. For first mortgages, policies ensure that all other liens, including taxes, judgments, etc., which might take priority over the lien of the mortgage, are either satisfied, paid off at closing, or legally subordinated to the lien of the mortgage. A mortgage policy is not designed to serve the same purposes or protect the same interests as a fee policy. Fee policies protect the owner and his entire bundle of rights to the property. Therefore, as long as the owner has an interest in the property and his rights do not diminish, neither does his insurance. Mortgage policies, on the other hand, protect a completely different interest. A mortgage is, in fact, a lien against the property. Therefore, the lender has completely different concerns than a purchaser. The lender's concern is not focused on the protection of the owner's rights, but rather the ability to collect on the mortgage. Mortgage insurance protects the priority of the lien, which means that in a worst-case scenario, if the house is sold and the money split between the creditors, it ensures that the lender would get his money before any of the other creditors. As we mentioned earlier, there are fundamental differences between fee and mortgage policies. Owner's policies are intended to protect the owner against any outstanding claims, liens, or interest that exists at the time that the policy is issued. The coverage of mortgage policies is designed to meet the security needs of mortgage lenders. This coverage, while entirely consistent with sound underwriting principles, is broader than that of standard owner's policies. There are two basic differences between the two. Firstly, because the only interest being insured in a mortgage policy is the lien itself, the terms and life of the policy are limited by those of the lien. In English, this means that the value of the mortgage policy is reduced as the balance of the mortgage is reduced, and when the mortgage is paid off and satisfied, the policy expires. The policy can never be worth more than the unpaid balance of the mortgage. This differs from owner's policies, which never decrease in value and only expire when the property is transferred to a new owner. Secondly, unlike fee policies, mortgage policies are automatically transferred to the assignees of the debt security. If ownership of the real estate were transferred or sold, it would cause the owner's policy to expire. However, mortgages can be transferred or assigned from one bank to another, and the policy will still be in effect. Furthermore, in the event of foreclosure and purchase by the lender, the policy will automatically become an owner's policy, ensuring the purchasing lender as owners of the fee against loss or damage arising out of matters existing prior to the effective date of the policy. As a general rule of thumb, mortgage policies are a much lower risk for the title insurance company than fee policies. The interest of an owner is much more extensive and varied than that of a mortgage lender. There are endless ways for a property owner to lose value because of title defects, and therefore the risk of a title insurance claim under an owner's policy is comparatively high. The rules for filing a claim are the same for a mortgage policy as for a fee policy, but the nature of a mortgage is such that the risk of realizing a loss is substantially smaller. For a lender to lose money due to a title defect is normally a very complicated matter, for the property's owner must stop paying the mortgage, because even if a title defect arises, the lender has not realized a loss if the mortgage is still being paid. Secondly, the property must go into foreclosure, at which point it will be auctioned off and sold to the highest bidder in an attempt to collect the money due to the lender. And finally, the property must be sold for less than the outstanding balance of the mortgage as a result of a title defect. If the property is sold for more than the balance of the mortgage, the bank is already made whole as a result of the foreclosure process and has no loss to claim for the title insurance purposes. It is interesting to note, however, that even in a case where no one is interested in purchasing the house, this scenario is still incredibly rare. This is because most lending institutions send a representative to bid at the auction to drive up the price of the property. In a worst-case scenario, the lender will buy the house for the balance of the mortgage and try to recoup its losses later by selling the property on the open market. As was mentioned earlier, title insurance is a state-regulated industry. As such, the premium rates that title insurance companies charge are set by the state and are the same industry-wide. The premium rates are calculated to include the title company's cost of the abstract, tax search, examination, production process, and closing. Rates are broken down into several different rate schedules based on multiple criteria. The basic categorical difference is whether we are issuing an owner's policy or a mortgage policy. Mortgage policies represent a much lower risk for the title insurance company than fee policies, and therefore have lower premiums. Furthermore, there are many scenarios in which the straight rate of the mortgage policy will be lowered even further to a reduced rate. The rates on mortgage policies are reduced as a result of 1. Simultaneous fee and mortgage transactions. 2. Refinancing of an old mortgage. 3. Simultaneous issuance of 2 or more mortgage policies. The reduction of these rates is calculated on a percentage basis, and the rules are too complex to make a detailed explanation worthwhile. Suffice it to say that it is very rare to insure a mortgage policy that does not qualify for any reduction whatsoever. Very few mortgage policies are charged at a straight rate. There is, however, one specific exception to this rule. Construction loan mortgages are considered much more risky than standard mortgage loans, in part because the balance of the mortgage is often much higher than the fair value of the property, especially in the case of new construction. The understanding being that the value of the property will be increased by the improvements that are being constructed. Consequently, construction loan mortgage policies are never issued at a reduced mortgage rate, and are in fact issued at a straight fee policy rate because of the additional risk. There are other issues surrounding rates which affect policy rates and complicate the overall rate calculations. In addition to the policy premiums, there are also many other charges associated with a closing. Municipal searches, which are not included in the premium fee structure, are unregulated, and the fees for these searches are set by each individual title company. There are many other costs, including recording fees, taxes, survey costs, and escrow service charges that are also collected by the title company at closing. As a final point, it should be noted that since state rate regulations are only for the premiums collected when insurance is issued, any searches, examinations, or courtesy recordings that a title company does which are not done with the intention of issuing insurance, at McGregor, these files have a separate numbering system which starts with MI or C, are not under regulation and are therefore charged at whatever rate the company chooses.